Madhav Dhar is joining us right now. Madhav, good morning. Good to have you back on the show after a month. Thanks for sitting through that commercial. Let me just ask, begin by asking you, Madhav, are we in for another round of global easing with what the ECB said last week, China cutting rates, and a lot of talk that Japan is going to sort of extend its balance sheet once again?
Yeah, no, it certainly seems like that. I think, all the authorities around the world are doing whatever it takes to prop up any kind of growth and lubricate and facilitate the global economy. And I think, I think looks like we are already underway on that, especially with the Fed holding off earlier last month, and then the talk we've had in the last few days. So that clearly seems to be the case. And I guess to some extent that's what the markets are reacting to as well, understandably so.
Other regions easing automatically means that, the dollar strengthens, and that means financial conditions in the US tighten, which means that the Fed kind of postpones any normalization even further out into the future, right?
Possibly. I think it's, no two periods are exactly alike, and history doesn't repeat, but it sort of rhymes. But, according to me, it's very similar to what happened in the late 1990s, that you had a Mexican crisis that triggered an emerging market crisis in 94, 95. Things bottomed out. Everything went up from 95 to 99, but the breadth kept narrowing. And after the first 2 or 3 years, in the mid-90s, the U.S. started accelerating. Within that, tech started accelerating the most. Emerging markets started slowing down. And it's a very similar feel, which is, that you have a narrowing on both growth leadership and stock market leadership centered around the U.S. against the emerging markets, and within the U.S. around tech. So I think it's a very similar cycle that's repeating itself. And if you look at long-term valuations, let's say the U.S. versus the rest of the world, or particularly emerging markets, they are as stretched as I've seen in 20 years. So the U.S. long-term PE is twice the emerging market PE, which is a 2 or 3 sigma event. So we are at a very, very extended point in terms of both relative valuation and relative growth expectations. I don't think growth reality, but growth expectations.
So you're saying that the U.S. markets, developed markets are very, very stretched, right? That's what you're saying.
Yes, particularly the U.S. And I think when the world goes ex-growth, money goes to safety and where there is understandable growth, and that is centered in the U.S. So it'll be good for the dollar, it's good for the U.S. PE. But again, I'm not predicting the future, I'm telling you what is happening and what's happened. And I think we're at a very late stage of that, whether it continues, whether it's 1998, so it's another year and a half to go, or whether it's 1999, and we are 6 months from a very important absolute and relative top in the U.S., I think that remains to be seen. I think we are very late in the game of global easing, and there's only so much you can keep pushing. The authorities are trying and they're pushing, and in the short term, they seem to be succeeding. They also had an extremely oversold global market a year ago. So I think right now it looks better than it really is. Things are bouncing very well, and it seems like they'll be able to engineer a benign scenario. But in the end, growth matters, and growth is fading.
But the conversation, though, in terms of you said that long-term P, US P is twice that of emerging market P, and that's it's quite rare for that to happen. So it's obviously showing us that, on a relative sense, things are stretched. But most of the conversation is still that what can emerging market slowdown mean for US growth? So far, actually, it has meant very little in that sense, right? Opinion is very divided in the US as well, but admittedly, growth there is picking up and the economy seems to be coming back on. and the emerging market crisis, so as to speak, is not hurting U.S. growth that much.
Absolutely.
So can this go on then?
It can go on. In the U.S., it can certainly go on a little longer. I mean, again, I think this is a myth that, that emerging market countries want to believe that, the U.S. needs them. They don't. I mean, the U.S. is the most internally self-sufficient economy and country in the world. I mean, all the innovation is largely internally generated. 10% of GDP is trade-related. It's a giant internally generated economy. And if anything, what little it needs in terms of lower labor costs elsewhere or lower commodity prices, you get that to boot. So the U.S. is extremely self-sufficient, which is why both the economy and the market are doing what they are doing. But I think cycles end and valuations and relative valuations can only stretch so much. And I think it's human nature to extrapolate the present. And I think that's the danger game, and that's the business we're all in. All I'm saying is, to me, it seems very late stage, and I think it's time to start looking the other way. It's time to start looking emerging markets long relative to the U.S. Perhaps cyclicals, even deep cyclicals long relative to whether it's consumer or the more interest sensitive areas. So I think. And what's hard to gauge is whether you are 3 months early, 1 year early, or 18 months early. But it's somewhere along those lines, because relative valuations, as I said, are so compressed, and I think growth is so suppressed that its odds are it'll start re-accelerating slowly around the world, and that should favor emerging markets, and they should favor cyclicals.
It's an interesting point that you began with, that EMs
being early and being wrong, and you can get run over.
Absolutely. I mean, last year, Madhav, there were a team of Morgan Stanley analysts wrote that a 1997 type of shock to EM real imports of around 15% would be enough to drag the US, Eurozone, Japan and Australia into a recession, right? We've not got that kind of a shock, first of all, to EM imports as they were thinking about. But we did get some, and I don't think we've got any big impact as far as US growth at least is concerned, right? I mean, so very quickly that piece of analysis has...
No, I don't believe it. I didn't believe it. Sorry, there's a lag. Go ahead.
No. I mean, I'm just saying that very quickly, in about a year's time flat, that analysis has proved to be wrong. Of course, the disclaimer is that EMs didn't slow down as much as 15%.
No, listen, I never believed that. I mean, I don't remember the specific study you're citing, but I think... people have gone broke trying to underestimate the United States for the last 150 years, and some Frenchman wrote a very important book. So I think those are just factually not true. And if you look at the marginal contribution of emerging market growth to the U.S., it's minuscule. And the U.S. also keeps reinventing its productivity, which goes directly into GDP. And so I think people continue to underestimate that. And I think what's happening to emerging markets this time is nothing compared to what happened in 97, 98, when Thailand first blew up, Indonesia blew up, and then Russia blew up. And the emerging market economy truly caved in. The U.S. accelerated right through that. And this time round, it's even less significant, frankly. I think what's more important to the world is how the European Eurozone has slowed down. The commodity area, to some extent, has slowed down quite significantly. But global growth is still healthier than that time. So to have less of a global slowdown, less of an emerging market impact this time and expect a bigger slowdown in the U.S., I think just logically, arithmetically doesn't make sense. I mean, clearly the difference is China is much bigger and much more important. So that slowdown should have some impact, and it's had a little bit of an impact. But for the U.S., it's still a speed bump. So I think that's not the issue in the U.S. The U.S. is, fatigue, is bull market fatigue price extension, relative valuation extension. And those are the issues, very similar to, 98, 99, 2000. So I mean, many bull markets die of old age. They don't always die of disease.
Okay, Annie, I'll write that down. Madhav, but accidents can happen, right? What we've seen in the healthcare space in the US. I mean, that was taken to be a proxy for safe growth, little international risk. But look what's happened there. From mid-July levels,
yes.
Top 10 US healthcare companies have lost some $250 billion in market cap.
Yep. As I said, I think the breadth is narrowing everywhere. So as it's like global warming, as the ice floes shrink, there are fewer places you can stand on, and it is safe growth, particularly in the U.S. And even that area is shrinking. So at some point you get to a tipping point, and the valuations in the safe areas and the areas you have predictable growth get really extended. And that's a classic late stage cycle situation. And the things where you have true tangible value, whether it's replacement cost of assets or price to book value or price to long-term earnings, they're so boring. The negative story of them is so obvious that nobody even talks about that. You and I talked about, that if there's a bounce, Russia will bounce the most, which is sort of what's happened. But nobody's really interested. Nobody's interested in buying metal and mining stocks in India or Russian stocks or Brazilian real and so on. But those are classic late-stage extensions. And as I said, the timing is obviously a little scary, but the world is arrayed as it tends to be at an important inflection point. And those inflection points can last 6 months, can last a year, and that's hard to predict. But there's no question in my mind we're at one of those big turning junctures.
Okay, very broadly put, the turn will push emerging markets into a period of outperformance, and developed markets, especially US, into a period of relative underperformance.
Yes.
Am I right in Go on.
Yes. Absolutely. And I think it could be turbulent in the early stages of that turn. Emerging markets could underperform. But I think if you have a 5, 7, 10-year view, I think you are at that cusp of relative performance changing dramatically. Because the growth still, whether you want to believe it or not, is in the emerging markets. And as that becomes clearer with the global easing ending and growth actually starting to accelerate, you will see not only rising earnings in emerging markets, but you see rising PE. And you'll see a little bit of the opposite in the U.S., which is maybe earnings might be okay because the economy is okay, but the PE will slowly deflate. And you couple that with a currency that's become almost too strong to currencies that have almost become too weak, your total return in dollars or your total real return on a relative basis could be very, very significant. I think we're at a very important 20-year cycle turn.
A month back, you'd said that next couple of years, you could expect 30% returns in dollar terms, right? I mean, from India. So you're still obviously backing that.
I don't mean per year, but I think yes, total return, absolutely.
Yes. So you're in the business of buying the unloved and the unwanted, Madhav. Does India fall in that category? It's certainly, if you read articles and self-praise in newspapers, it seems like we are the only one. If what you are describing happens, which is that EMs start a period of outperformance, I mean, all the money is going to come here.
No, I don't think India falls into the unloved category. So it's somewhere in the middle. You and I talked about it a while ago that I think if this turn happens, I think the deep cyclicals will do the best. I think Russia and Brazil will do better than India will do. But I think what India has going for it is a high-quality growth story. So it'll benefit a little bit from the turn I'm talking about, but I do think the turn may not be a big, sharp cyclical turn, but it may be a moderate turn up, and in which case India may fall perfectly in that category where a little more predictable growth, the growth bands are 7% if we do everything wrong, 9% if we do everything right, or somewhere in between most likely. I mean, that is terrific. What India doesn't have going for it is truly compressed PEs. So valuations aren't that compressed, except in certain areas. So your upside, your huge upside is limited because you may not have the PE expansion that the rest of the cyclical emerging markets may get. On the other hand, the earnings, both the magnitude and the quality and stability of earnings will be higher. So it should have a higher PE. So India falls somewhere in the middle. More predictable, less cheap.
We've not talked about the local factors at
play. And it's still overweighted, so it's not as unloved as some of the other areas.
But we can use some more love, I guess. Some would put it. We've not spoken about the local current conditions and factors at play, the political economy, the upcoming Bihar elections, the impact, the reforms, or the lack of it, whatever. Would you want to weigh in a little bit, Madhav? How do you see all of those things panning out? Or rather, your observations?
Listen, I think all of it has been a little disappointing in the last 18 months. And so there's been very little sort of headline-grabbing stuff, and what there has ended up being disappointing, whether it's land reform or land acquisition or GST and so on. Having said that, I mean, you keep hearing that there's a lot of stuff under the hood that's happening. A lot of projects are going to come through. Government spending is going to accelerate. By the way, I do believe that. So I think you will see positive momentum in the economy over the next 6 months, with perhaps it being more clearly visible 9 months or 12 months from now. So I do believe that. So I think we went from an extreme high in expectation in May last year at the height of the election, and perhaps you have a complete give up that happened 3 or 4 months ago. So you've gone from an extreme high to a relative low. And from that standpoint, I think the odds are there'll be some mildly positive economic momentum in India, with perhaps rates coming off more and inflation coming off more. So I think that's largely a positive, benign scenario and very healthy for the markets. Is it what it could be? Is it what you desire? Is it the kind of decisive sequential steps you need for India to sort of unshackle itself and reaccelerate? No, but I just think that, I think we've all realized that those are sadly unrealistic expectations. So within bounds of Indian reality, I think things will be sort of fine. So I guess that's my view, and I maintain that this will be one of the best long-term stories, and it continues, frankly.
Are you a election bug, sort of buff, Madhav? Bihar elections, any thoughts? A lot of people believe that even if BJP loses,
yes.
Buff, sorry, not bug. Or bug, rather. Anyway, buff. Let's stick with buff. Let's, Madhav, so many believe that even if the BJP loses, it's not bad. And the logic is that they will focus on growth a lot more. How do you think about it? Because there are lots of state elections next year as well.
I've stopped thinking about it. I think there is, there's a story for everything. There is some kind of entirely plausible scenario that is terrible if BJP wins and terrible if BJP loses, and very good for reform and very bad for reform. There's completely plausible scenarios. I mean, I would just simply remind you that over 35 years, India has grown 6.3%. The growth has been higher in fractious coalition governments. They have been in majority governments. So executive decisiveness has not translated into growth. So I can't say cynical, but I'm very agnostic about what politics means to the reform agenda or growth in India. I think the bigger question in my head is whether the administration actually understands and believes in reform. No, not as a buzzword, but as what are the underpinnings it actually needs to achieve to unleash growth, and where is that ideology in the administration, where is it housed, what is the full buy-in on that, and what is the stomach for implementation? I think that's the question. So I think the political mandate for that we already had in May. So that has come and gone. So I'm sorry. I mean, I think that everybody, it was that. Then everybody was waiting for Delhi election. Delhi election was a signal. Then something would happen. Now let's just wait till Bihar and then let's see what the formation of the Rajya Sabha is. I think it's a fool's game. I think Indians by nature are political junkies, and that game goes on. I think its predictive value on what happens to the trajectory of the country or the economy is close to zero.
Okay. All right. Fair enough. Any thoughts on the big money which continues to flow into the e-com space, Madhav? Are you tracking that by any chance?
Well, I follow it, and it just, it's fantastic in a way. I mean, in the sense that I think the marginal contribution to productivity around the world largely is IT oriented. So the more money that can come in there to fund wild, crazy, life-altering ideas, so much the better. So as a global citizen, I'm very excited. As a person watching the world turn, I'm very excited. I mean, am I excited as an investor? Do I want to follow that herd in a late stage cycle and expect to make more money of that? No, that's an entirely different question. But I love it. I mean, I think, as a student of history and market and economic history, there are different kinds of bubbles. You've seen bubbles in tulips in Holland 500 years ago. You've seen bubbles in Japanese real estate. You've seen bubbles in banking and mortgages in the U.S. And you're seeing a bubble in tech. Tech bubbles are beautiful. They're wonderful. Tremendous good stuff comes out of it, even though there are a lot of dead bodies at the end. Japanese land bubbles, they're nothing but dead bodies with no marginal contribution to productivity. So as far as bubbles are concerned, I'm all for tech bubbles. They're wonderful. They're very healthy. They have no debt involved with it. There'll be huge bankruptcies. For every 4 successes, there'll be 100 people who will lose money in specific companies. But those survivors will transform humanity. So I'm all for it.
Madhav, beautifully put, as always. Thanks very much. Great speaking with you. Really great speaking with you. Thanks very much, Madhav.